Inflation's at what? It's at a 40-year high? We're going to tell you what that means to your life. Stay tuned. You're listening to Financial Sense, Arizona's financial podcast that gives you insights that you could only get from having a friend in the industry. Recorded and brought to you by National Bank of Arizona, the only bank you need. Hello, I'm your host, Brent Cannon, Director of Community Banking here at National Bank of Arizona. Thank you so much for joining us today. Today, we're talking about a topic that is certainly top of mind, inflation. Today, we have joining us Anthony Valeri, who's the Director of Investment Management at Zions Bank Corporation. Anthony, welcome.
Hey, thanks for having me.
So, Anthony, on this podcast, we love to give people insights that they can only get from having a friend in the business. With that, let's get into it.
All right, let's do it.
So I think we should just start with defining what inflation is and kind of what are the key metrics, statistics, and how it's calculated.
Yeah, there's lots of measures of inflation, Brent. Probably a lot more than people ever thought possible. And my job is to sort through that. The most popular measure is the Consumer Price Index. That's the one that gets quoted most in the media. It tracks a basket of goods and services. So it's not just things you buy, but it's also a service. And it tracks those on a weekly basis from family purchases across the country. It's probably the widest, broadest, and again, most widely cited measure of inflation. And it'll quote a monthly change and then a year over year change.
So where are we? Here we are in March of 2022. What's kind of the current rate? I think I saw a January number that's been published, but where are we?
Yeah, we're at a very high level. So yes, that January number you referenced, 7.5% on an annualized basis. It's the highest since the early 1980s. Certainly gotten a lot of attention, and it is an issue. It is likely to remain high. The Russia-Ukraine conflict is throwing a few more question marks into how long this inflation persists, whether it'll go even higher. But yes, it's at a high water mark for sure.
One of the things I've read and heard, and I suspect a lot of our listeners probably have too, is this idea or this debate. But is the inflationary transitory, which in my mind means short term, moving through, transitory, or is it systemic, or maybe a combination of both? And let's start with this concept of it being transitory, and then also, if you could, hit on this demand pull, cost push idea of inflation.
Sure. So, the idea of transitory, thankfully, the Federal Reserve, Fed Chairman Powell threw that out the window late summer, early fall of 2021, when it became apparent that it wasn't transitory and that inflation was going to continue to accelerate. To the extent it is, I don't see this as a return to the 1970s by any stretch. Inflation will remain elevated, but it is expected to come down. So if your view of transitory is a deceleration by late 2022, then I say yes, inflation will come down. The expectation broadly on Wall Street was for that measure to come down to 2.5%. But there's good reason to debate whether it actually would fall that far. I don't think it will. And now with this Russia-Ukraine conflict, it'll probably stay higher than that. In fact, we may even see a peak March, April, as opposed to what I would have originally thought, probably peak early in 2022. So it's likely to persist. The other element that is somewhat not transitory is that the housing market has been so strong. Rents remain very elevated. Those types of inputs into the inflation calculation are likely to be more persistent and not come back down. There's a low interest rate component to that as well, but the gains in that housing component are starting to spread to other metrics, and it's a sign that this inflation is remaining sticky. So I think it'll stay higher and won't fall as far in 2022, but high level, yes, it will decelerate here, likely over the course of the year.
Talk about the demand. I think it's the demand pull inflation, especially given the pandemic, this pent up demand that occurred in the supply chain. Talk kind of how those factors really, impacted this inflation rate, if you could.
Sure, and I'll probably take a step back. You reference a key point is inflation demand pull, or what we call cost push. In the 1970s, it was cost push. It was high commodity prices, oil, that really pushed through to higher inflation. We now in today's economy, the energy intensity or usage here in the United States is only about 40% of what it was in the 70s. So energy is a much smaller impact in the economy, and therefore not going to be a big driver longer term of inflation. Really what we saw was a demand pull, very strong demand. And you think about the pandemic, hospitality, leisure really hit hard, but the rest of the economy, after just a short distraction, began with business as usual. So a good part of the economy really wasn't impacted. That's not to diminish the impact on some of those sectors, but large portions of the economy came away unscathed. At the same time, you had record government stimulus, you had the Fed slash interest rates. All of that money ended up boosting consumer savings. So there was this strong demand component. And during the pandemic, you couldn't really spend on certain things. So that those savings stuck around and has led to very strong demand. The other aspect, and there's two more components. One is the supply shortages. As we tried to reopen the economy, that led to higher prices. And the labor force really hasn't grown. In the US, immigration has been really fallen off. Part of that is due to the pandemic. Part of that's also due to government policies. And we just don't have enough workers. So all of that's leading to higher wages, which is fueling that higher demand, creating that inflation. So it's a complex issue that is getting better. Those supply shortages are coming off from the data that we follow. But yes, this is going to persist, Brian.
So, Anthony, that was great. So now we're probably going to further complicate the point or the subject of inflation. And we'll talk about systemic and some of the tools that are at the Federal Reserve's, in their tool belt to handle this. And just for listeners, when we talk about the Federal Reserve, their two mandated objectives are to, I think, maintain employment and maintain price stability, which that's the subject of really our discussion today, inflation. So if you would talk a little bit about how you see the Fed's role. Again, we're coming out of a period where we had unprecedented spending to address the coronavirus, COVID, and its impact on the economy. But also we've been in this long period of quantitative easing, which I know, again, I don't want to get too complicated, but it's important, I think, as in the Fed's role in inflation. So with that, systemic, love to hear your thoughts on this.
Yeah, on the Fed's role, they are a little late to the party, and have to take that with a grain of salt. The Fed wanted to do everything in its power to support the economy and bring it back from COVID. The response was tremendous. They did what they should have done. I think you have to give them many kudos in that regard. And in 2021, just slow to recognize that inflation was going to be persistent. And through the first part of 2022, was still buying bonds to help keep rates low, which is really amazing when you think about it, despite the talk of an interest rate hike coming. So in the first quarter, we should see the first interest rate hike. The Fed's expected to raise rates a few times throughout 2022, 4 to 5 times, let's just say. That could change. But that is the primary mechanism by which they will try to slow down inflation, raise interest costs slightly so it makes it harder for consumers to finance things and help at the margin ease those pressures. I think part of this is also beyond the Fed's control. They don't have an impact on certain commodity prices. Those are spurred by some other factors, and therefore some things are out of their control. To your point about quantitative easing, they are also expected to finish their bond purchases in the first quarter, and then it's anticipated they'll begin to actually just let those mature and roll off in June. Now, we still don't have details on that, but over time, as they don't buy bonds, it'll be interesting to see if that also has an upward pressure on interest rates, which would also serve to slow the economy and bring inflation back down. So those are the two ways the Fed can influence or at least try to slow down and control inflation.
You hear this definition or this description of inflation, too many dollars chasing too few goods. I hear that a lot. And I guess that's probably where we see this. Reportedly, the Fed spent an unprecedented $6 trillion in response to in response to COVID and its impact on the economy, primarily through the Economic Security Act known as CARES and also the American Rescue Plan. So with this government spending, connect the dots for folks. Okay, we hear 6 trillion. First of all, most of us can't fathom what a trillion is. And, so we'll leave that alone for a moment, but 6 trillion, how does that kind of connect those dots, if you could?
Sure. To put it in the magnitude of what the government did in terms of spending relative to the size of the economy for 2 years, 2020 and 2021, the government spent in terms of stimulus, basically over 10% of the size of the economy, just a staggering number. And put it together, it's double the response that happened in 2008 following the great financial crisis. So a tremendous response. And that's part of what's fueled this inflation. Big, powerful response, which I think the initial round was the right thing to do. And now it's obviously questionable whether the government should have gone that far, but that's, hindsight's always 2020. But that's where we are. That was just to put into magnitude the amount of spending. And that doesn't even count what the Federal Reserve has done in terms of bond purchases, interest rate hikes, just a really strong coordinated response.
Yeah, I think I read that number at 4 trillion in terms of, so I guess to kind of wrap this up, systemic versus transitory, really it's combination. Like most things in life, it's a little bit of everything.
That's right. It's both factors at work. It should come down, but for the meantime, it will persist because consumers were in good shape. It hasn't really had that detrimental an impact to the average consumer yet, but it's going forward. Will it? It very much could. So we'll have to keep an eye on that and see its impact on the economy and in turn on the stock market.
All right. Excellent analysis there, Anthony. Thank you. Now I'd like to transition into how inflation really impacts, us, right? People living day to day. And, we have bills, we have to buy things like food, and we have to pay for things like our electricity bill. And heaven forbid, we have to fill our gas tank up because that number starts with three numbers for most of us now. So, yeah. Let's talk about how inflation impacts really people's wages, their cost of living, and their purchasing power.
Sure. So at the margin, that inflation is going to erode purchasing power and therefore is a negative on consumption, which can weigh on the economy or drag it down. What we've seen so far, though, is because of that stimulus, because of the fact you couldn't spend money during the pandemic for a wide range of time, consumer savings went really up. So the consumer really weathered that increase in inflation fairly well. You also had wage gains. We've seen the strongest wage gains since the early 80s. Non-supervisory employees making on average 7% or more on an annualized basis. So it's not even, but as it goes into 2022, to me, that's a major question. How long do these sustained inflation increases, the cost of filling up your car, finally weigh on your spending habits? And we are seeing some initial signs that is being a drag on the economy in 2022. It's an unknown at this point, but at the margin, yes, it does erode purchasing power. And to the extent that your wage gains don't offset it, it could be a drag. So those are the things to watch. It's one of the key developments we're watching for 2022.
Speaking of that, my mind goes to, okay, I'm working, I'm saving for retirement. I'm trying to figure out, I want to make sure that all of this hard work and savings, doesn't ultimately get eroded by inflation. So, one side of, I think the discussion is, how does it impact my current living experience? But then the next question is, well, how does it affect my savings for retirement? So talk about that and maybe some tools that people can think about and use to offset the impact of inflation.
Sure. And that's obviously a very common topic in my world. And how do we invest and protect your purchasing power over time? I don't know if a lot of people know this, but stocks are actually the best hedge against inflation over the longer term in terms of growing your savings and outpacing inflation. Stocks have repeatedly been the best solution. Now, the knee-jerk reaction is I want to own commodities, oil, And yes, there's been spikes in commodities whenever we have had a turn higher in inflation, but it's usually short-lived. So when you think about a longer-term 5-year, 10-year, 15-year plus horizon, which really that's what you should be thinking of in terms of retirement, then stocks have outperformed commodities. And that's really where the focus should be. If you own bonds, that's more problematic because interest rates are still low, even though they've come up, and inflation is going to erode the purchasing power of those bonds. So it is a balance. Bonds still work to protect on the downside, but you really do have to work and think about what's the right mix of bonds versus stocks. And for some clients, the answer is to increase stocks to weather that inflation over time. So from an investor standpoint, thinking longer term, it errs to the side of making sure you have enough or even maybe more stocks, despite ongoing market volatility over the longer term. That's the best way to hedge against inflation.
Yeah, it's really interesting. So, I guess continued, you would, I'm sure, tell folks that you speak with, your clients and others, speak to your investment advisor, have these discussions. It's truth is we haven't thought about inflation for 40 years, in any real sense.
That's right.
Yeah.
No, this is the biggest shock since then in 40 years. So yes, do talk to your financial advisor and see how your portfolio is positioned and what you could do.
So Anthony, I guess the question is, how much sleep should I lose thinking about inflation and retirement, and frame this, if you would, if I was 30, 40, 50, and 60?
Yeah, no, good question. And my reaction would be don't lose any sleep over it. There are things you can do to manage it. And there's also benefits that I think not benefits, but there's some other aspects to take into account. If you're young, you start saving and know that you have that really long horizon, 10, 20, 30, 40 years to let that savings grow in the stock market and outpace inflation, which stocks have done over the longer term. There are periods they don't, but over the longer term, very consistent outperformance relative to inflation. If you're in your 50s, keep doing that. Keep staying in stocks. Stay invested. Be noteful of the amount you have in bonds currently. If you need to save more to help give yourself a buffer. That's a bit more of a financial planning discussion you can have with an advisor to see if your savings and future inflation might erode that. But yeah, for the most part, keep doing what you're doing, save more if you need to, but really make sure you've got your investment portfolio built to weather that inflation. The other factors I think people maybe don't know as much is your home. If you own a home, that is a good inherent hedge against inflation. You've seen home values rise. And the other part is interest rates are still low. So while costs of some things have gone up, interest rates still make buying many other things relatively affordable.
So Anthony, let's give listeners hopefully a positive to take away. Love to hear your outlook of kind of what you think the future holds. I know you've touched on it earlier, but give us kind of a 12, 24, 36 month outlook of what you see happening and something that our listeners can kind of take away.
Sure. When I look at longer term, from an investment standpoint, I don't think the next year or two maybe be as strong as the last 3, which has been very strong despite everything that happened to COVID. And I do think that inflation may persist longer than people think, but the economy is still growing at a decent rate. People are experiencing wage gains. For the most part, this is a healthy economy that continues to expand. And I think the resumption of getting back to normal activity during the second quarter of 2022 and beyond may be understated. People, I think, are ready to get back to their normal lives. So that should be a positive for the economy. Also, don't underestimate the positives. Interest rates are still low, which make buying some big ticket items very affordable. I know houses pricing is very expensive, but still for many items, those low interest rates help. The average consumer, the Fed keeps track on this, the average interest rate or debt burden the consumer has is at a multi-year low. So consumers are in good shape financially. And then at the margin, we have seen some wage pressures. Over time, I've always said to myself, bet on humanity. I remain optimistic. And I think with all of those factors, low interest rates, a still expanding economy, I think most people will be just fine. Just be prudent about investing and saving for the future.
That's some great perspective, Anthony. And I think you've just done a wonderful job sharing your perspective on inflation, the economy, and savings. So thank you so much for joining us.
Thank you. And you're welcome. Enjoy the discussion.
That's our show for today. Give us a like. Don't forget to subscribe on your favorite podcasting platform.